Here's exactly how I'd invest $4,000 into the market at this moment in time if I was looking to build consistent passive income stream from crypto even when the markets are acting up. Now the plan is to invest 4,000 into this as a starting capital. Now this may seem small to some people out there because obviously there's a massive amount of money that's been mentioned and covered in videos, but as I said, I try to keep it as real as I can and as honest as I can in everything I produce. So here's the goal. Our goal is short term, learn yield farming actually works while earning around $40 to $80 a month. Medium term, we want to grow to around $200 to $300 a month in passive income, and long term, we want to build a small but powerful spot bag that are going to earn while we sleep. But just I suppose before we go any further, make sure you like, make sure you subscribe to the video. Let me know in the comments what you think of it. But I suppose the big question here is you have to kind of understand it yourself. Would you reinvest the rewards you earn, or are you looking to just take the capital out of it? These are two different goals and two different approaches you'd have to take. Let me know in the comments what you would actually do. Reinvest or just take the cash and use it daily. So our overall plan here, you can see we have two different phases here roughly built out first. So our phase one is going to be learn and earn pretty much. And in that, what you're going to be doing is getting into USDC, ETH, pairs like that are relatively stronger in compared to other tokens. Now, again, it's crypto. If we all know what's happened over the last week or so in crypto, and pretty much at this moment in time, still things are a bit unsteady and not 100% sure what way things can go. But like I mentioned here, our stage one is ETH USDC. Now we have options here. I'll quickly just kind of show two of them. We can obviously go over here to VFAT, pick our positions. Our Pancake Swap, which is obviously hot at the moment with BNB chain, has also the same things. So this is obviously shown as Solana, but if we quickly jump to ETH. So we have positions here with ETH USDC 180%, but I calculated roughly around, I think it was when they load up, it was around 100% of an APR. Again, this was setting me in a range of roughly 15% up and down. So again, a little bit tight. You could eke it a little bit more and lower the APRs a little bit down. But for this purpose, as I said, keeping it around this because we want to obviously reach our short-term goals, and we definitely want to pay attention to KPIs. So within the first obviously month of using this, around 100% APR is roughly $83 a month. Now again, it's not an extreme amount, but you're going to learn from that, I think, is going to be massive. You're going to understand ranges. You're going to understand the importance of setting a range that's not too tight, because hopefully you won't be going in and out of ranges too often, and you'll understand how to actually manage it. Now, if you wanted to be a bit more risk averse here, and you could look to get into stablecoin positions here, they will give you the learning phase, but they won't give you much of a return. And it seems like a lot of capital is used for not really getting anything whatsoever back. So again, you have options for stablecoin farming, which is going to be much lower APRs. Again, you're talking maybe 10%, 12% maybe for the entire year. Again, you're very similar to what you would be getting in the S&P 500 stocks and things like that over a yearly basis. So if we jump over here to stage two, and pretty much stage two really steps us up a little bit more. Now, I put Solana still, this is what the SOL token is, Solana still as a risky asset, because I would consider the main ones to be Bitcoin, Ethereum, and even Solana, as I said, I wouldn't, because it can fluctuate massively, the price, and over time, obviously, Solana hasn't been around as long as obviously Ethereum. So in phase two, I tend to look for these kind of assets. Now, again, I'm not looking to risk it all. I'm not looking for crazy high APRs. This was 150% APR, but anywhere I looked at, it was working. So it's even gone up now on this range, and the range is still even a little bit far out. So I had it, I think, was around 60, even 0.5%, give or take, which was still giving me nearly 180 to 200% of an APR. Again, I said I don't like having really high APRs. I want to bring it down, and even with this, you could bring it down a little bit more. But you can see here, hopefully you can see there. Yeah, so you can see here 150% APR is around $375 per month. So phase two has moved us up massively to grow our portfolio in the medium term targets to $200 to $300 per month easily. Now, if you're nervous, risky, you can always reduce these APRs by making your range much wider, and obviously bringing these down, helping you stay within range, obviously better, but also, you're still getting decent enough returns and for your capital. Yes, positions will go down in price, will go up in price, fluctuations will happen no matter what you do. Same what happens if you invest into stocks. Stocks will go down, stocks will go up. Crypto will do the exact same thing. Our ability to earn through yield, I think, is one of the most powerful tools we have access to, I suppose. And as I said, it's definitely an opportunity. So with that, we have two different positions earning for us. Now, the key thing here is what you want to do is, like what we have in our targets, we want to build up long-term holdings of crypto and potentially open more doors of ways to earn. So with that, all we can do is you can funnel 100% of the rewards, like I asked at the beginning of the video, is what are you wanting to do? Are you looking to take the cash and run? Are you looking to take the cash and compound? Or are you take the cash potentially and build out your spot bags? So in this instance here, I would always look to build out spot bags. So you could set it of each monthly rewards, you could bring 30-40% of these into your spot bags. Now, the benefit of doing this is going to allow you to do two things. You obviously grow your overall bags that you're happy to hold long term, but with borrowing and lending, you can provide these as collateral to potentially open doors to get a bit more cash flow into your different pools in phase 1 or phase 2. Again, depending on how risk tolerant you are. This is the exact process that I do. This is the exact process I always talk about within my own group. And I think this is one of the easiest ways to kind of start building and slowly getting used to crypto and yield farming ways of building out portfolios. So with that in mind, I done some more calculations over here, and hopefully you can see this. And just before we go into these, as I said, make sure you like and make sure you subscribe to the channel. You know, I'm really trying to push this channel now as hard as I can and grow and help people like myself that are looking to learn more about yield farming and growing passive income, I suppose, from crypto. So we have two options here. The compounding approach, this again is very out there approach because APRs will fluctuate massively, so it's not set in stone, of course. So 6-month realistic return, you can almost expect a 91% growth in your portfolio. Now, I think I mentioned that over here is one of my KPIs is monthly income increase. So plus 10 to 20% a month on month. Again, if we don't see these KPIs being tracked, what you will have to do is you'll have to start adjusting, see what's right, see what's wrong. And I think this is just some general KPIs I put into it, but you know, having these is going to help you understand. And KPIs, if no one's familiar with it, it's key performance indicators. It's something that you track and helps you understand how things are going, how they're working. So as I said, our 6-month realistic returns is 3,600. 12-month return, considering we're compounding these, of course, which is 10,000, so almost $11,000, a 273% growth in your portfolio. Obviously, the main driver in this is going to be the Solana USD position. But after a year, your 4,000 initially could be worth 14.5 or $15,000. Again, this can definitely fluctuate massively. It could also be true. It could go the opposite way. There is nothing to say that 4,000 can't turn to 2,000 either. That's something you have to be aware of and understand 100%. However, if you decided you didn't want to compound, you just want to take the cash out, you have two options. Option 1 is you invested into your spot bag. So as I said, you have roughly $458 a month going into your spot bags and growing that, or you have $458 a month going to pay your utility bills, whatever, in your day-to-day life. That is also the option. So as I said, hopefully this kind of helps you understand a bit more of the power of DeFi, the power of yield farming. And what I'm trying to do here is show as much information as I can, do as much of the groundwork as I can to help you understand the options out there. Don't just think because you have a smaller balance, you have a smaller wallet, you can't start. You can start from any value at all, provided you have enough to pay the fees, obviously, of that chain. Hence why I always say pick chains that have low transaction, low fee cost per transaction. Clearly set yourself some sort of goals. This is one thing I can't emphasize enough, and I wish I did it much earlier than what I did do, is you need a goal for what you're doing. Each position has to have a purpose, and you have to be able to track and see how it's performing and what it's doing. And I think that is one of the big things. And plus, it stops you from jumping into FOMO into things that you know yourself that you're not really comfortable or happy with. So look, I'm going to leave it there. Thanks very much for watching. Any questions, let me know in the comments, and I'm more than happy to help anyone.